We think we're at one of the most attractive entry points that we've seen since the GFC. What makes that attractive entry point is we have values that are still down 15 to 20% across sectors. That decline in values has largely been driven by interest rates as opposed to fundamental factors. Fundamentals have remained relatively stable and they're recovering. At the same time, replacement costs are up at least 30%.
We're in the later innings of a reset that really started in 2022 when rates went up pretty significantly. At the time, I think what the industry expected was to see a lot of distress, forced sales. That really hasn't come to pass. That said, there remains plenty of assets that are not adequately capitalized for this rate environment and will need to be worked through either recapitalizations or sales.
What we're seeing now is the ability to buy really high quality assets at discounted values with improving fundamentals. And that's quite similar to what we saw in that 2011 through 2013 timeframe. The other thing that I think is worth mentioning is what we've seen happen with financing conditions. So over the last 18 to 24 months, financing conditions have really turned a corner and has gone from being a headwind to a tailwind. And I think most importantly, we're starting to see positive leverage. In our view, sector selection is table stakes in today's market. You have to be in the right neighborhoods, but you also have to be able to find the right assets and then execute a value-add business plan on those assets. I think there are several benefits to a more diversified and flexible approach in today's market environment. This K-shaped economy that we're seeing is creating a lot of dispersion and uneven performance, both across sectors, but also within each sector and at the asset level. And so I think having a flexible approach and the ability to pivot to where the opportunity is as the cycle evolves, I think is more valuable than ever.
This is not an environment where you can just buy the market, where you can't just step in and say, I'm a buyer of all multifamily in Southeast, or I'm a buyer of all industrial on the West Coast. You need to find idiosyncratic one-off situations. And those situations bubble up from relationships with local operators, local brokers, local lawyers. That is really key to sourcing opportunities. Our partners are co-investing side by side with us, and they're true real estate operators. They're in a given market, they live in the market, they're generally active in just one asset class. They know the business. They know the business from an operator's point of view. And so they have tremendous capabilities to execute, whether you're talking about leasing or renovation or capital improvements or better management. They are true bricks and sticks kind of real estate people. The other thing I'd say is our team. Our team is very real estate centric. Most of our team has real estate operating experience. They like the real estate side of the business, the true operation side, and they bring a lot of knowledge to the table. And they know a lot about what makes a successful repositioning of an asset work. A lot of experience in renovation and leasing capital projects. And so because we have both really strong operating partners locally and executing, and a team that's well-versed in real estate, operations, and execution, I feel like that we are well-positioned to kind of navigate this cycle that is all about operations and execution.
The fundamental backdrop is that the U.S. is largely undersupplied in housing. It really has been since the GFC. Most estimates are that the U.S. is about 1 million units or more undersupplied. Today's interest rate environment has made home ownership cost prohibitive for many, which has been a tailwind for rental residential. The challenge in today's market is that you can't just broadly pick a market to invest in. The research has to go well beyond that to the property level. And so we have been extremely focused on our asset selection, partnering with the best local operators, and those are the properties that we're focused on.
Seniors housing is something that we've been heavily focused on. COVID-19 was a big disruptor for seniors housing, but now it really feels like the sector is coming back in the limelight. The supply pipeline has really gone down. The demand profile continues to escalate, and that really sets up well for the fundamental growth in the sector. And so really, as it stands today, we're back to prior peak occupancy, at a point when supply is still relatively muted and demand is accelerating as we approach the silver tsunami or the rapid graying of the U.S. population. So the next couple of years will be pretty ripe for investing in the sector.
We see there to be several years of continued rent growth. And the reason for that is you've had this dynamic over the last 15 years where rents have not really kept up with net worths from seniors. And that has really manifested itself in the form of housing values, which are up, call it 50% from 2020, or stock market holdings, which are up, 80 to 90% in terms of what the S&P has done since 2020. And both of these really create the means by which seniors can afford senior housing.
Student housing, on the other hand, I think it requires quite a bit of discernment. Being a half mile in the wrong direction can mean the difference between having a great asset and a perennial underperformer. So it really requires discernment, careful individual asset selection, and knowledge of the sector.
Student housing, it's one of the most resilient residential asset classes when you think about the demand piece of it. However, the market now it's very much a tale of two cities, of the haves and the have-nots. The haves are the largest tier 1 state institutions that are getting the majority of the enrollment, and the have-nots are the smaller, more regional schools where you're seeing declining enrollments.
The evolution of student housing is going to be deeply tied into AI, as many things are. I think what's going to happen is that there's going to be a growing gap between the large state flagships and the secondary institutions within each state. And the reason is that AI will fundamentally change the workforce, and we believe that the schools that are able to reinvest in their offerings, to reinvest in their facilities, to best capture how AI is going to change the workforce will be the most appealing to students looking to figure out how to get ahead in what appears to be a more competitive work environment. And so we really think that that gap will continue to widen. The U.S. is fundamentally an aging population, and the older we get, the higher the demand for healthcare. Every day, around 11,000 Americans turn 65, and as we get older, we consume more in healthcare. We're spending about 18% of GDP on healthcare. That's up from around 6% in the 1980s. And healthcare spend has grown for every year in the last 25 years, except for one, and that was the onset of the COVID-19 pandemic. So we're seeing this continually expanding demand for healthcare and the need for the hospitals and the providers to keep up with that.
The other thing that's happening with medical is that there's a fundamental restructuring in how healthcare is delivered in the U.S. More and more medical is being pushed out of hospitals into surgery centers or adjacent medical buildings. And so it is very interesting to own medical office that's campus adjacent or on campus. It really has a natural demand driver, and it's benefiting from both the demographics and kind of the structural changes we're seeing in healthcare.
The sector has always been very stable and low growth, but what we are seeing is that over the last couple of years, there's been a rapid escalation in the cost of construction and the requirements for yield for developers. And so what that's doing is created a pretty large gap between replacement cost rents and in-place rents market-wide. And so even in a sector that's historically been stable and low growth, we're actually seeing occupancy tick up over the last couple of years, and we're seeing more pricing power as the landlord and the owner of these buildings because there's not enough replacement space being brought into the market. Medical outpatient is a really highly fragmented segment of healthcare. The ownership group can be doctors groups, it can be health systems, and so the way we're investing in healthcare is trying to fix and figure out a way to invest in a sector that's fragmented through aggregation ventures, which is multi-tenant buildings anchored by health systems or market-leading providers that are in markets that have a deep provider base, that have strong fundamentals from an insurance standpoint, affluent demographics, heavily insured demographics, and trying to aggregate that in a well-diversified portfolio in target geographies.
As a team, we've done a lot of research on the industrial market in the U.S. We've ranked every market as well as every sub-market to identify where we would like to invest. So with that approach, we've formed programmatic ventures to acquire assets in both the Southeast as well as the Midwest, and those have been key fundamental markets for us where we're looking to acquire in the future.
From an industrial demand standpoint, Florida really has some unique hallmarks. Number one, as the third largest state in the country, it's been a magnet for population growth through a business-friendly climate, low taxes, good weather. And so that really portends well for industrial and logistics demand. It has so many unique demand drivers, ports, air, freight, and just general logistics, that there are so many avenues of growth where it's really been a strong performer. And given the land constrained nature of the state, I suspect it'll be a very strong performer going forward. We have really strong operators throughout the state of Florida, and that's really the lifeblood of our business. They serve as a tremendous sourcing channel and a tremendous flow of information that allows us to make informed decisions and stay ahead of a market which is really sought after from an investor standpoint.
We are paying a lot of attention to the onshoring megatrend in the U.S. With recent legislative bills, we are seeing continued manufacturing investment in the Midwest, which we think is going to drive great fundamental growth. In addition, the Midwest tends to be a very low supply market, so we think that the Midwest industrial is ripe for rent growth. Minneapolis industrial is over 50% manufacturing based, which creates this really sticky tenant base and allows for that tenant base to have overall better fundamentals in the market. The market is also below 4% vacancy with less than 50 basis points of new supply. So we see that market is ripe for rent growth. Chicago is a 1.4 billion square foot industrial market. It's the largest industrial market in the US, so you have to pay attention to it. Chicago industrial also has sub 5% vacancy with only 1% of supply under construction, which creates a great environment for future rent growth. And a lot of that supply is already spoken for. Despite some of these great fundamentals, has typically traded at a discount to some of the coastal growth markets, creating a yield premium for investing there that we find to be very interesting.
The Sun Belt has a lot going for it, and domestic migration patterns over the last few years really support that. People are drawn to the Sun Belt for overall quality of life, affordability, job opportunities, and at the same time, companies are drawn to the Sun Belt because of the pro-business environment and the access to labor. However, absorption in the Sun Belt has remained exceptionally strong, which gives us a lot of conviction that the softness is a temporary supply issue and not a systemic demand issue. It means that in today's market, you have to be very selective on which assets you choose and why. Industrial outdoor storage, or IOS, are logistics properties where the bulk of the value and the utility to the tenant are actually outside the building. It's an essential part of the supply chain. It's the link between the primary source of goods to the traditional warehousing and then ultimately delivery to the final customer. IOS has been one of our most active segments because from a demand perspective, it has a lot of the same tailwinds as traditional industrial, such as e-commerce and reshoring. At the same time, in most markets, it faces shrinking supply. There's a few trends that we've really noticed in iOS over the last few years. First, having properties in good locations that can serve a very diverse tenant base is critically important. For example, over the last few years, freight has slowed down, but we've seen a meaningful uptick in tenants that are supplying data center construction, whether it's components or heavy equipment. From a supply barrier perspective, this is something that has only accelerated.
We've been investing in self-storage for over 15 years. We've bought over $1 billion of product, as well as bought over 100 assets. In self-storage, we've typically bought assets from non-institutional owners, implemented dynamic pricing, tenant insurance, as well as implemented best management practices in order to drive better margins. Today, the market's very fragmented, with over 60% held in non-institutional hands, so we tend to buy assets in very idiosyncratic ways that no two deals tend to look the same. Self-storage is very unique in that we've seen headline rents go down by almost 1% every month for 3 years straight, which is a unique dynamic. But over that time, we've still seen NOI growth. Those headline rates today are really just concessed rates, and what the tenant is actually paying is getting increased over the life cycle of that tenant, which is able to drive NOI growth. You've seen the overall supply-demand shift. You've seen a lot of supply delivered, and that's still going through the current market. And so you're seeing really interesting bases that we're able to acquire these non-institutional assets at. Self-storage still continues to be a business with great underlying fundamentals. When a tenant moves out, you just broom sweep that unit and it's ready to go to the next tenant. There's no heavy CapEx costs, there's no heavy tenanting costs, and margins can be up to 70%. So while headline rents and occupancies have fallen slightly, you're still able to generate really, really interesting cash flow.
AI is such a critical focus for our investment strategy because of the way AI is rapidly changing so fast. We like to think of it as if you're not using AI, you're going to be beat by somebody that is. And we're very lucky that we're at the forefront of AI because we invested in building a data science team almost 10 years ago. And because we have that team in-house, we were able to leverage their skills that as AI has been getting better and changing as it is every week, we're able to stay ahead of the curve. And so because we have been implementing AI, we already have insights that other teams wish they had. The way our team has been able to use the replacement cost dashboard has been pivotal for our team when underwriting deals. Because we have the proprietary insights at our fingertips, you're not able to find anywhere else. You can't find this information online. We only have this information because we've been collecting it over the past couple of years. It's been so fun to be able to hear the ideas that people have and be able to implement them because we are able to create so much value with these tools that we're able to develop in-house. TPG Angelo Gordon has an operating partner model where we work very closely with our operators. As the head of capital projects, I work very closely with all of our operating partners. And so there's a strong dialogue of sharing best practices between each other. It's table stakes creating efficiency with AI. And what we are so focused on is using AI not just to become faster, we really are focused on using AI to become smarter, to find opportunities that other people miss, and to have better conviction in the deals that we move forward with.